Good afternoon, everyone. We are very happy to have with us today the management of Sobha Ltd. The management is represented by Mr. J.C. Sharma, Vice Chairman and Managing Director, Mr. Subhash Bhatt, Chief Financial Officer, Mr. Ramesh Babu, VP Finance, Mr. Vigneshwar Bhatt, Compliance Secretary and Compliance Officer, and Mr. Balamurugan, Investor Relations, VC and MD's Office. Now hand over the call to Sharmaji for opening remarks. Over to you, sir.
Good evening, everyone. We are pleased to connect with you today post declaration of our audited financial results for the fourth quarter and financial year 2017-18 ended 31st March 18 through this con call hosted by FY18 Securities. Thank you, Sandeep, for doing it. We already shared the details of our operational update of the company in the first week of April 2018. The investor presentation based on the financial results adopted by the board can be downloaded from our website. As you are aware that the last financial year which has gone by has been a historic financial year from our sector's perspective. The year began post the trauma of the demonetization, and we had to also transition to RERA era, as well as we had to adapt to the GST requirements. This somehow did affect most of the operational performance of most of the real estate companies. But in our case, you must have noticed that every quarter we kept on improving on all our parameters. And we had shown steady growth in our residential space across all product categories, supported by equally strong growth in our contracts and manufacturing verticals. So more or less what we have been able to demonstrate that when the pricing power was not there very much, when the market had shown some kind of a headwind, we had gone ahead without launching new projects in the first 3 quarters by selling our existing products, collecting money, also executing projects for our clients in the contracting and the manufacturing division, adapted to the statutory requirements as far as RERA was concerned, adapted to the GST requirements, and could come out with a satisfactory performance where without increasing in the price, due to some operational leverage, we could show improvement in our overall profitability and could sustain and maintain our EBITDA margins, PBT and PAT. We believe that while the kind of a headwind which was witnessed in the last financial year is not that severe, but still the industry as a whole continues to suffer from some kind of a demand stagnation, and new launches are still not very many. In this environment, we still feel that with the kind of new product launches we have geared for ourselves and the kind of visibility we have in our contracts and manufacturing division, this coming financial year also we should be doing better than what we achieved in the last financial year, both operationally and financially. One of the good notable points what we have also noticed is that whatever we have sold, we had collected more or less that kind of money from our customers, including in contracts and manufacturing. First time ever, we collected 3,000 crore plus, which helped us to bring down our interest costs, and also we as a total payout, and also we've been able to bring down our interest rates, which stood at 9.39%. Going forward, we believe that while the banks have started increasing these costs, we hope to bring it down further by 15 to 20 basis points more. As far as the guidance was concerned, we deliberated, but the board was of the opinion that looking at this kind of a current environment, we need not have to commit ourselves to some specific numbers, even except that our revenue growth and our profitability growth in this financial year will continue. Now I hand over to our CFO Subhash Bhatt to talk more about the nitty-gritty of this financial operation.
Thanks, Sharmaji. We are pleased to report that we have achieved the highest ever revenue for the quarter as well as for the full year, that is FY17-18, and this was backed by very good operational performance across all the categories and across all the regions that we operate in. We also feel this reflects the confidence of our customers in the brand Sobha, in especially the post-RERA era. Coming to the revenue and profits for the full year 17-18, revenue for the year FY17-18 stood at 28.37 billion, which was up by 24%. Real estate contributed 20 billion, which is 70% of the top line, and the contract and the manufacturing business contributed the remaining 7.86 billion. Real estate and contractual revenues were up by 34% and 4% respectively. EBITDA for the year stood at 5.69 billion and the PBT came in at 3.17 billion. EBITDA margin remained stable at 20%. PAT was seen at 2.16 billion, which was up 35%. Coming to specifically the fourth quarter numbers, that's for the Q4 FY17-18. Revenue for the fourth quarter stood at 7.89 billion, which was higher by 31% as compared to the corresponding period last year, and sequentially it was 13% up. Real estate contributed 5.01 billion, which is 64% of the top line, and contracts and manufacturing contributed 2.68, with the balance 196 million coming in from other income. EBITDA for the quarter stood at 1.56 billion and PBT at 907 million. Profit after tax came in at 654 million, which was higher by 40% compared to year-on-year and 22% on a sequential basis. During the quarter, two projects, namely Sobha Ltd and one wing of Sobha Dreammaker, reached revenue recognition threshold during the year, and revenue recognized was rupees 695 million. Coming to the cash flow, as Sharmaji mentioned, this year as well as the quarter we had the highest collections both in real estate and contract vertical. For the full year 17-18, our total collections stood at rupees 30.08 billion, which is higher by 24% as compared to the previous year. Real estate collections stood at 20.93 billion, and the contract and manufacturing collection came in at 9.15 billion. We generated a net operating cash flow of rupees 3.75 billion after meeting interest and tax expenses. Specifically for Q4, cash inflow during the fourth quarter was rupees 9.11 billion, which was higher 31% on a year-on-year basis and 35% sequentially. Real estate collections during the quarter stood at 5.98 billion, and contracts and manufacturing came in at 3.13 billion. We generated net operating cash flow of rupees 1.6 billion after meeting interest and tax expenses during the quarter. This is the 11th successive quarter where the company has generated net operating positive cash after meeting the financial outflows. This robust collection has helped us to bring down our debt by rupees 1.28 billion during the fourth quarter itself. Debt equity came in at 0.79 as on 31st of March 2018. We have managed to further bring down our cost of borrowing at end of fourth quarter to 9.39 billion. This is the lowest average rate achieved by the company ever since its inception. Coming to the performance highlights for FY17-18, as we had communicated during the first week of April 2018, we sold 3.63 million square feet for the financial year 17-18 with a total value at rupees 28.62 billion, with Sobha's share of sales coming at 24.22 billion. Annual sales volume and value both were up to 21% and 42% respectively. During the fourth quarter, the company has achieved new sales volume of 1.02 million square feet, valued at rupees 8.12 billion, of which Sobha's share came in at 6.56 billion. Sales volume and value both were up 40 and 46% respectively during the current quarter as compared to the corresponding quarter last year, and 9% and 8% as compared to the sequential quarter of this year. During the year, we completed 5 regional real estate projects and 11 contractual projects, measuring to a total area of 5.8 million square feet. In addition to this, 2.68 million square feet of real estate projects were completed and OC was applied for the same during the year. Coming to the contracts and manufacturing business, the financial year 17-18 was one of the best performing year for contracts and manufacturing vertical. Total revenue from contract and manufacturing for the full year came in at rupees 7.86 billion, which is up by 4% as compared to the last year. Contract vertical contributed rupees 4.53 billion and manufacturing vertical rupees 3.33 billion of this. Also, this vertical achieved best ever collections both annually and on a quarterly basis. Total collections for 17-18 stood at 9.15 billion, which was higher by 26% as compared to the previous year. Contracts vertical achieved 5.38 billion and manufacturing division delivered 3.75 billion of this. As of end of March 2018, our contractual unbilled value stood at rupees 17.4 billion. This is one of the highest ever order book that Sobha has achieved. We are also pleased to inform that the company has bagged new contractual order during the first quarter of the current financial year, which is FY18-19, for constructing Azim Premji University campus at Bangalore. The total order value of this is 5.63 billion. Future launches. The company has planned to launch about 6 to 8 new projects across our existing locations. And also, as communicated earlier, the company is working out on various new geographies and new opportunities. A step in this direction was a foray into the Gujarat residential market with Gift City transaction, which is targeted to be launched during the current financial year. Also, the board has recommended a dividend subject to shareholders' approval at the AGM of ₹7 per equity share. Thanks. We request now the participants to put forth their questions.
Sure, sir. Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touch-tone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abhishek Anand from JM Financial. Please go ahead.
Yeah, good afternoon, sir, and congratulations on a very good set of numbers. So my first query will be with regards to the Bangalore market. Sir, it's been some time since RERA has been implemented. Firstly, would like to listen to you how the implementation has been and whether some of the unorganized guys have moved out of the market. How have been the first 9 to 10 months? And secondly, how has the supply situation now improved with most of the bottlenecks away, RERA bottlenecks being taken care of?
Abhishek, it's like this. Right now, still, theoretically speaking, since the demand velocity is quite low vis-a-vis Bangalore's potential, what we have been doing 5-6 years back, 45,000 to 50,000 units a year, I am given to understand now it has come down to 20 to 25,000 units a year. So there is a slowdown in the demand. At the same time, there have been lots of ongoing projects. Rough market estimates that the ongoing inventory in the Bangalore market ranges between 70,000 to 100,000 units. So that kind of an overhang still exists. But when we look at the ground level, practically speaking, from the progress point of view, and the market has its own ability to discern whether this project has been there for how long, whether likely to be completed or not. From that perspective, more or less, even if you have been registered because you were an ongoing project, the sales offtake of those developers is not there, and they are not launching new projects. The number of active participants in our sector in Bangalore market has come down, maybe according to my rough estimate, by almost 50 to 60%. So remaining 30-40% people, they are not right now active, at least. They may come back tomorrow, but they are not active. So that is where we see as organized players a kind of an opening where we believe that we can continue to gain market share even in this low velocity environment. We did 2.6 million square feet, and the last quarter was one of the better quarters amongst many quarters. This year also we believe that Bangalore market should be outperforming in our scheme of things because lot many new projects have been planned. 2 projects have already been approved. Hadasidupura project, Bellahalli project has been approved. One joint development also we have taken. So we believe that with the launches being lined up from the next quarter onwards, in our case, we should be doing relatively better than what we have achieved in the last financial year.
So, just to delve on that, our launch pipeline, if you could give us some more clarity. So you mentioned Devanhalli and one more project which has been approved.
What I mentioned was there is one project, Hadasidupura, 25 acres, where BDA development plan has been approved. The building plan is yet to be approved. A. B. That affordable housing development plan has been approved. The building plan is to be approved. Then there is one project on Old Madras Road, which also, where the building plan has also been approved. We have to make application for the RERA. And then in Mysore, one plotted development, we have already applied for the RERA. So these are the 4 projects which are at the advanced stage from the launch perspective, and there are 3 or 4 more projects which we should be able to launch by the end of this financial year.
So definitely higher than what we launched.
100%, significantly higher.
Okay. So secondly, will be on the collections which we did, especially on the real estate operations. We collected some 600 crores. As historically our run rate has been closer to 500 crores. So is this related to RERA registration? So basically the demand letters were not issued?
No. It is nothing related to the RERA part. What you need to understand is that we did not have many projects for launch.
Hello.
Abhishek, just hold on. It seems the line for the management got disconnected. Participants, you are requested to stay connected while we reconnect the management. We have the line for the management reconnected.
So sorry, Abhishek?
Yes, sir.
Yeah. So what I was telling that last year we had sold most of the inventory which was existing inventory where the billing helped us. This year, more or less, there will be the existing inventory and there will be new inventory also. But still collections, we believe that will be higher than what we have achieved in the last financial year.
Okay, so around 600 per quarter is the run rate we should be looking at?
Sometimes we don't talk and go by the quarter-wise basis. We say, yes, the big picture is we should be doing better this financial year on all the fronts what we have talked about. So on the volume front, on the what you call the collection front, and on the profitability front, and on the launches front, we should be doing better this financial year.
Sure. So just one last one, if I may. So just trying to understand your strategy behind entering into a new market like Gujarat or Gift City. especially when we know that Bangalore market, there is, of course, potential of you gaining market share in that particular market. So what's the strategy behind entering a market like Gujarat?
See, real estate, what we have seen, primarily you do not get clear land, primarily do not have an approval process streamlined despite whatever assurances we are getting from multiple sources. This GIFT City, whatever little bit we know, it has been in progress for now more than 10 years, where some kind of attraction had started coming of late, with almost 16 million square feet of the land out of 62 already given to multiple developers. And you have already now more than 7,000 people working there physically, and every month 300 to 400 new employees are joining. First time when they have allotted this land, they have given a concession that this apartment can be sold to anybody. Till then they had a constraint that we can only sell these apartments to the people who work in the GIFT City. So first 5,000 units, they have made it free. So looking at that part, looking at the FSI cost, looking at that the payment has to be made over a staggered period of 4 years, we thought it's a good opportunity to de-risk ourselves and try out a new market. Investment is not going to be that large, and we would have entered into a good growing market from an experiment point of view.
And this will be all our construction, no outsourcing or anything?
No, never. We will never do that part.
Yeah. Perfect. I will join back in the queue. Thank you so much.
Thank you. The next question is from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, good afternoon and thank you so much for the opportunity. Just continuing a bit more on the new launches. So what is the total million square feet that you expect to launch in next year?
It's subject to all approvals and registrations in place.
Yeah.
We are targeting 8 million square feet of new launches.
8 million, okay.
Yeah.
Okay. And again, carrying forward with the collection, so why is the run rate higher if it's not because of RERA? I couldn't quite understand that. If you can give more color there.
I never said. That was the question the previous speaker had posed, whether the RERA helped in improving the collection in the last quarter.
Correct.
RERA has got nothing to do with this collection part.
So is it more to do with the project mix, or is it it's just higher realization?
You can say, yes. More to do with the way the billing pattern emerges, the collection pattern follows that.
Okay. And what is the expectation of project completions for next year? How many million square feet do you expect to complete?
In the real estate front, it is close to about 4 million plus, Pune.
Okay.
It's again subject to see after the RERA, you can officially treat as a completion after the fixing of OC.
Correct.
From our internal construction point of view, we complete the project and we apply for OC. Officially, we declare once we receive OC.
Okay, great. And you also, gave good color on the market. Just wanted to get some sense if you are seeing any signs of realization improvement at the market level as well or not.
I wish that it happens sooner than what we have been expecting so far. But looking at the pain, looking at the leverage, looking at the supply side kind of thing, while the actual demand, clarity and comfort is far greater, the pricing comfort, I think still we are a bit away.
Okay. And do you have some sense of how long it will take for the pricing to come back?
Can't say. Sometimes in India, it happens suddenly. But one can say with certainty that the way the input cost increase is happening, both on the labor side as well as on the material side. The commodity prices had gone up in the last 2.5 quarters, to be precise. Otherwise, also it will become unviable at the current prices for the new guys to launch the project and compete with the existing one.
Correct. But isn't land cost coming down that can, offset some bit of this construction cost increase?
Land cost may be opportunistically here and there, but still I do not foresee land prices per se coming down in the areas where the demand exists.
Look, Puneet, in the regions that we operate, land doesn't constitute a significant portion of the overall cost.
But it will still be about at least 1/4 to 1/3, isn't it?
Yeah, but then even if it is a 10% improvement, you're talking about 3% on an overall basis.
Right. Okay. And lastly, if you can give more color on what's really happening on the contractual business, that seems to be doing quite well, both on revenue and on cash flows. What is driving this, new leg of, growth here?
I expect nothing. Right, when the Infosys jobs were there, we used to focus on one customer and we used to keep them happy, relatively speaking, in a better manner.
Right.
Now we find that the similar kind of comfort with the other existing contracts is happening. So Biocon keeps giving us new jobs, Lulu keeps giving us new jobs, right? And now we have got Ajim Premji as well. So we have got good clients. That is on the contracting side, who have been supporting us in a big way. On the manufacturing side, we have become relatively more aggressive. Both our interior division as well as metalworking and glazing division, facade division, what we call, both of them have done a record performance and they have got, again, a good visibility. So our belief is that this year, definitely looking at the visibility part, that the contracts and manufacturing division will again show a very good improvement on this higher base.
Okay. On the manufacturing side, I thought you were largely supplying to yourself only, right? Or is it that you've added new customers outside of?
100% of our own construction activities, like what Bala was telling, the 4 million square feet, what will be completing and other projects which will be taking up, everything is in-house.
Right.
That is not shown as billing. What we are talking about is the external billing, where now more and more clients, they are coming forward and giving jobs to the manufacturing division. And on the contracting side, with existing customers, they keep giving us whatever jobs they are getting when they grow. So with their growth, we are also growing.
So if you can give, more color on this side, on the manufacturing, who are these new customers and,
See, they are 5 crore, 10 crore, 15 crore kind of a customer, but yes, they pay on time and the jobs get completed also on a timely basis.
And this is largely interior work for their buildings?
Interior doors, normally. We don't do the interior part. We supply the doors, or we supply the kitchen and the cabinet to our customers primarily, as far as interior division is concerned. As far as part is concerned, in our presentation also you might have seen one building which has been beautifully covered with the glass facade and trees being shown in our investors presentation. This is one of the unique jobs our this facade division has done, where we collected more than 40 crore rupees. So this kind of jobs also we are getting.
You're talking about the Lulu Cyber Tower 2?
Yes.
Okay. Yeah, so that's a contractual part. On the interiors, which is kitchen and doors largely, so it's the smaller developers to whom you are supplying, or is it what kind of guys are these?
All sorts of developers. As a customer, there is no small, no big. The orders part we get on those, we supply. Big developers are also there, smaller developers are also there.
Okay.
Similarly, the curbstones, pavers, and blocks also, we are supplying to most of the developers.
Okay. Great. That's all from my side. Thank you so much.
Thank you.
The next question is from the line of Samir Baisiwala from Morgan Stanley. Please go ahead.
Hi, thank you very much, and good afternoon, everyone. Jesse sir, on the 8 million square feet new launches, just your clarification, is this the total size of the project or is this the area to be released?
This is the total size of the project, where plans will be approved And what we are doing now, that we will be registering with the authorities the whole project as well. We'll be completing the project on a phase basis. We'll have different time schedule, but registration we'll be doing at a time.
Fair enough. And so what would be the area that you will be releasing this year?
Area so far not detailing them, but still maybe relatively speaking, almost 3 to 4 million square feet definitely will be released.
So Samir, our plan of releasing tower by tower based on how the sales have been done in the area released will still continue.
Okay. So is there any change in the selling philosophy, which is to sell as you build, or do you also want to keep some inventory at the end, a much higher inventory that that couple of other developers are now trying to do?
No, Samirji. We will continue to keep selling while we are building. Sometimes there can be some small inventory left out, not by design, but by default or inability to sell, you can say. But otherwise, we'll keep selling. So as things stand today, also as on 31st of March 2018, 147 crore worth of finished stock inventory was there, 4 million square feet. Out of that, 4 lakh square feet. Out of that, 250,000 square feet is plotted development, and 150,000 square feet is the apartment unsold inventory. So we are quite comfortable that way.
Okay. And so from the time you got all the approvals and the groundbreaking happens, till the time the delivery happens, what's the time frame now, and is it very different from what it was in the recent past?
We have not tinkered with the time frame, what we used to offer to the customers earlier. 7 except in case of the Dream Acres, the precast, where delivery is happening subject to OC almost in 2 years' time. In almost all other cases, we are taking 3.5 years or so on an average.
Okay, fair enough. And so final question, in your outlook for fiscal 19, maybe you did not make a mention on the balance sheet. How should we think about the net gearing and new project acquisition over the next 1 or 2 years?
See, Samirji, we have been clear that, the debt equity should be kept around 0.8. That is what in the last quarter's concall we had communicated when it was 0.86. It has been brought down to 0.8. And should be continuing with this kind of a debt equity, looking at the number of opportunities what we are having, and we will be also completing this year at the St. Mark's Road, this 400,000 square feet of the developable area mall in the next quarter. So all these things will be met within this 0.8 debt equity part.
Okay, and on new project acquisition or new geographies to enter?
Yes, unfortunately, this GIFT City happens faster. Some projects definitely we are looking at in Hyderabad, Trivandrum, and one more new city also we are planning to add. If something happens in the next quarter, we should be giving the clarity. It will be a tier 2 city.
Okay, great. Thank you so much.
Thank you, Samir.
Thanks.
The next question is from the line of Adidev Chattopadhyay from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. So just my question is now on our reported margins. We have been below 20% over the last couple of years. So with higher realizations which you have seen in the real estate segment, so for next 2 years, could you give some guidance on sort of reported EBITDA margin we could see?
See, Adidev, whatever these margins you have seen, these are all the legacy margins on the projects which had started almost 2 years, 3 years, 4 years back. Point number 1. Point number 2, in the last 6 months, unfortunately, there has been an increase in the input cost. Almost all the commodity prices, they had gone up. Point number 3, you may be not observing, but in India, this blue-collar employment, the way this government is going after implementing the minimum wages, the provident fund coverage, and other benefits the cost per labor continues to keep rising. On top of this, we have been planning almost 3% as a thumb rule towards our sales and marketing related activities. We felt that looking at this environment, we need to be more aggressive, we need to have more campaign at all levels. And now we had gone up to some quarter 5%, some quarter 4% sort of a thing on the sales and marketing side. So while the product mix has been good, we have succeeded in selling products across all price category and in at least 3 regions relatively much better. These costs also were required to be absorbed, but could do it within the parameters what we have set out for ourselves. If the commodity prices become softer or remain stable, we are confident that the margins again can only go up from these levels as things stand today.
Okay, so just to clarify, have you booked any like cost overruns in this year? Because I earlier used to give a disclosure if any projects were going over budget.
No, that is where we have been careful in estimating and putting these kind of costs upfront while making the estimates. We did it at the time of last revision.
Okay, so then any further update on our APMC, that commercial project?
That also some progress has happened in this year. Definitely we should be able to provide clarity about that.
Okay, so then the debt equity we are mentioning, the target excludes any possible capex on this project, right? Or
right now we do not have that kind of a sufficient investment meant for the commercial space, and right now we remain reasonably confident that we have a little bit of a headroom to grow on our volumes, on our cash flows, and on our profitability. So we believe that this 0 point debt equity should be sufficient enough to take care of all our commercial as well as real estate and the contracting related activities.
Okay. So just my last question on this contractual order book, the 1,700 crores plus 500 crores, like 2,200 crores of order book we have. This is executable for over what period?
It will take a minimum 3 years to execute.
Minimum. So we should be sustaining basically the revenue run rate we have done in the previous year.
Of course, yes. And still there is a small scope, despite not going out in a big way to gain the market share in this field. We have been quite choosy.
Okay.
You will, that is why our margins are industry-leading margins, and our collections are the best ever collections in the contracting sector any company can claim about.
Sure, sir. That was helpful. All the best. Yeah.
Thank you. The next question is from the line of Abhinav Sinha from CLSA. Please go ahead.
Hi, sir. Good evening, sir. So on the sales bit that we saw for the fourth quarter itself, Bangalore was doing quite well, but the other cities have slightly lost momentum. And I mean, going forward, how you are looking at this? But specifically on the NCR market also, because I think the sales sort of peaked like 4 quarters back there.
You have a point. Sometimes what happens, the product what we release, the composition of the product versus the demand as it emerges. So while we have 3 million square feet plus to be sold, to be delivered, what we got ourselves registered, within that the larger size apartments has gone faster. So 90% of the larger size apartments had gone in the last quarter itself. But due to the production constraints, we can't simply release because you have to see that the handover and the overall infrastructure is put in place. These kind of setbacks do take place little bit. But net this year we do expect that Gurgaon market should be doing better than what it has done in the last year as a whole.
Okay, and in Bangalore itself, the inventory of that higher end, which was coming mostly into POCM, is it now done?
See, more or less, the high-value products from the legacy, they are gone. When you talk about Indraprastha, when you talk about Palladian, we talk about Grandier, on the Richmond Road small projects, they are gone. But we have added Pristine and the Huddersfield-Pura, a very large project where you will have some of the premium products as well, should be launched hopefully by the next quarter. So it will be made up, and we do not foresee much of a problem.
But by and large, the momentum that we are seeing of, say, rising sales now five quarters continuously, you think this is maintainable? I mean, 6.5 billion becomes 7 billion very soon.
Maintainable. Because we believe that we have performed in a shrinking market. As the market expands, definitely with the kind of locations and the kind of track record what is getting established, we should be doing better. There is a scope.
Okay. And so just one question on the contractual side as well. So here the area that you have on hand of ongoing projects has been coming down, right, for some time now, while the value is increasing. So are we doing something different?
No. It is a good question. One is that the manufacturing part, what we do, the billing happens, but the area doesn't get added. A. B. Okay. You understood my point?
Yeah.
Right. Then on the contracting side, till the structure is not given, and I am not adding. So most of the billing, like last year we did on the Infosys, the structure part was not there. They did not start new software development blocks or the food court or something of that type. Some visibility is coming in this financial year. So hopefully let us see, this part also will be there. But net, yes, the visibility is relatively best ever as we are entering into the new financial year on this front.
And are the margins now different here, or it's still 12-13%?
The margins, we live in, again, a tough environment. We are getting margins, and more important, we are getting the cash faster. So the focus has been on that part, then on increasing or improving the margin. Margin improvement happens primarily on efficiency front nowadays, than on any other sector.
Okay, so thanks a lot.
Thank you.
Thank you. The next question is from the line of Kunal Lakhan from Axis Capital. Please go ahead.
Yeah, hi, good evening.
Good evening, Kunal.
Hi, Sharmaji. Sir, my first question was on the land payments front. We have done some...
Can you speak a little bit louder?
Can you be closer to the mic, please?
Am I audible now?
Yeah.
So my first question was on the land payments front. We have done some 360 crores of land payments this year, bulk of which obviously came from your payment for the Kochi land. But I just wanted to understand, going forward, how should we look at this number, especially with now even Gift City coming into our books?
See, Gift City payment is already made for the year. Correct? It's not
during the current quarter.
During the current quarter. It is not part of the Q4. Right? And in our statement, investor statement, Bala does provide, there is almost 70 crores of requirement as balance payment. It will not be required to be paid fully. If some new opportunities come here and there, we may have to provide for. But in all probability, this year, that the payout towards the land will be less than what we have incurred in the last financial year.
Even if you exclude it for the one-time Kochi land payment, would...
That is done, na? Cochin is 100% done. So Cochin has got nothing to do now.
No, so what I was trying to say was, like, excluding Kochi, the land payment would be about 200 odd crores. So would the FY19 outlay would be lower than 200 crores, or it will be lower than 360?
We can't commit that way. That is where we say the basic idea is that keep the debt equity under 0.8 and grow your business within that parameter. This 0.8 also is among the lowest debt equity of any real estate company, what we are talking about at this point of time. Ours is the only company where the debt has not gone up in last 3-4 years.
Sure. So my second question was on the GIFT City project. You broadly have given us the guidance in terms of the investments going into that project. But overall, what could be the revenue that we could generate out of the project, and what could be the profitability? If you can give some numbers.
This is a new market, correct? We have to test it. We are launching in the first phase about 450,000 square feet, 450 apartments under that affordable housing scheme. So even if sometimes in the affordable the pricing is on a lower side, but on a percentage basis, it will not have any adverse effect or impact on our overall margins. And we look at this as an incremental revenue generating exercise with an access to a new and faster growing market. So this will be an experiment. Overall impact may not be that great, but somewhere looking at the way the industry is faring, we get some extra buffer to grow, is what we are looking at from the GIFT City product.
Sure, that's helpful. And so lastly, how should we look at your foray in Gujarat? Like, will this be a standalone project, or will we look at getting into other cities, or we'll restrict ourselves to Gandhinagar or around that region? How should we look at your strategy?
It's premature. As far as GIFT City is concerned, GIFT City, Gandhinagar, Ahmedabad, they may have different PIN code postal addresses, but prima facie the market remains the same. Little bit of small overlapping may happen, but generally speaking, it is the same market. So that we'll consider as one market only. Going into the other cities will take time. Once we enter into a particular city, our belief has been we have to be there for a much longer period, and that is what we would like to do with this Gujarat market, GIFT City as well.
All right, sir. Thanks for taking my questions, and all the best.
Thank you.
Thank you. The next question is from the line of Dhruvesh Sangvi from Prospero Tree. Please go ahead.
Yeah. Am I audible, sir?
Yes, you are audible. Can you give your introduction once again?
Yeah, my name is Dhruvesh. My name is Dhruvesh Sangvi.
Yes, Dhruvesh.
I'm participating for the first time on the conference call. Excellent set of numbers, sir. Congratulations. Just wanted to understand on the broader point of view, let's say over the next 3-4 years, as you said, for example, the Bangalore market from 40,000 has probably fallen to 22,000 apartments. Where do you see the cities where you are present? And is there some degree of confidence that, okay, in the next 5 years, we can see this easily bouncing off again to 40, 45, 50, or maybe much higher numbers? Or some kind of context in that angle in terms of the demand within certain cities?
Dhruvesh, it is like this. Good evening. It's a good question. See, the real estate market in the last 4 to 5 years, it has not behaved according to the economic requirements of our country. At the same time, parallelly, the kind of steps which had been taken over a period of last 3-4 years, we have not seen in 30-40 years of this sector cumulatively and in a combined manner. Now the only drawback remains is the approval process. It's also in case of like in GIFT City, there is zero approval process. They themselves approve the project. It's almost parallel sort of a thing. Only zero approval is required. Now that kind of a stage may take another 4 to 5 years in India, but we are moving towards that direction. And with affordable housing, with PMAY scheme in place, with interest costs coming down, and the way the grade A office space and the overall per capita income of the city dwellers has been rising. Hello, are we audible?
Yeah, you are audible.
Oh, okay. So, the way things are panning out, and then we compare Indian markets with that of the contemporary markets in other countries, in other cities, we believe rightfully that we have a long way to go. And in India also we have seen today that a cement company has a capacity of 100 million tons. A steel company has got a capacity of 30 million tons. So when we are operating in that kind of an environment where both these are the critical inputs for our own sector from a consolidation point of view, it gives us hope that our kind of a business model where we can think of scale, we can deliver the projects, we have got the required organizational strength. We have been always delivering, but failing every time in not being able to achieve either our potential or of the real estate sector's potential. Now, post these reforms, at least I am personally convinced that we are on the right track, and from now onwards there can be only one trend, which is a good secular sustainable growth in our sector with more focus on the affordable homes where the pricing power will be limited, but it will be more than offset by increased supply, increased demand of that particular product. Now, still long way to go when I talk like this, but this is what we believe and preparing ourselves towards that. Hopefully, things should become clearer in next couple of years' time.
Great. So then one more question, and thanks for answering it in a nice way. One aspect, so can we say that because you are producing your own homes, the kind of cost that you may be going through is already taking in, you're basically building a large capacity for yourself, and therefore the margins are also to an extent suppressed. And if such a scenario comes, which you are envisaging, will it lead to much higher operating margins without the corresponding increase in per square feet rate?
Too many ifs and buts will be there while answering this kind of a question. But prima facie, the belief is we do agree that we carry a much higher carrying cost to operate this organization. And as we start selling more, delivering more, executing more, the benefit of this operating leverage will start accruing to us. Presuming so many things should also happen in a desired manner, we operate in an industry where we sell first and thereafter we incur the cost. And we have to have the best possible estimates to support and stick to. More or less, we are successful in protecting our margins. But prima facie, I do agree that as we move forward with the larger volumes, the benefit should accrue to us.
Great. So last one part, any plans for Mumbai entry?
We have been looking at Mumbai also, but still we do not know how to get into it.
Okay.
We hope at some point of time some guy gives us a good opportunity.
Thank you, sir.
Thank you.
Thank you. The next question is from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Hi, thanks for the follow-on. So just one final, any thoughts on land monetization for fiscal 19 or maybe a little beyond? And do you want to replace your really long-dated land bank with something that you can develop in a shorter time span?
Both are good questions, and we are doing our level best to see how do we optimize and achieve these objectives. As far as fiscal year 19 is concerned, the final notification from the Bangalore Metro Railway for acquiring one land parcel of almost 5 acres has happened. The compensation amount is yet to be fixed, but hopefully it should materialize in this financial year. As far as maturing or materializing the other larger land bank parcels, we are working on Narganhalli. We have started working on Haskote as well. Hope to provide some clarity as we move forward. But beyond that, I am not in a position to convey anything significant as far as the near future is concerned.
Okay, that's great, sir. And anything that you want to sell down this year? Any big ticket item?
As I said, that itself should give us good cash flow as and when this matures. But even except that, nothing is there in the pipeline as things stand today.
Okay, and 5 acres, Bangalore Metro, that's a new land acquisition talking about.
It was there, I think...
Samir, this is the one on the Banagata Road, which Bangalore Metro has issued the acquisition notice for.
You may not be remembering.
Yeah.
Oh.
Which has been in works for last probably 2 years. Yeah, 1.5 years. So, there is interest which is accruing from particular date which they have issued the notice because they didn't want the guidance value to go up. So, hopefully, as and when it happens, it should give us at least 150 to 160 crores for that 5 acres.
Okay, now I understand. Okay, got it. Yeah. Thank you so much.
Yeah.
Thank you. The next question is from the line of Ujjwal Shah from Quest Investments. Please go ahead.
Yeah, sir, thank you for taking my question. Sir, can you give us some guidance in terms of your affordable housing foray in Bangalore? And secondly, we have seen that most of the top-notch Bangalore players have actually announced so-called affordable housing projects in the range of 50, 60 lakh bracket. What kind of potential do you see for this segment in this market, and do you see at some point this getting crowded? Thank you.
At some point getting? Crowded. Hello?
Yeah.
Yeah. See, today, if the developers are focusing on a product which is meant for the larger audience, it is only good. And then in any market, if you see, if there are margins, there is demand, it is likely to get crowded over a period of time. Right? Bangalore market has always been one of the most competitive environment where we have been managing and maintaining our leadership position for last 10 years or so. So per se, we are not afraid. We understand the technology. We understand the product. Currently, the largest selling project and the largest ever approved project belongs to Sobha, and it has done very well. So we per se do not foresee that in a market where the size is bigger than the normal market and the incentives are reasonably well, even if it gets relatively crowded, it is going to have any adverse impact on our plans.
Right, sir. So what are our plans in that case over next 2 to 3 years?
We already shared that in our previous conversation.
Okay, fine, sir. Thanks.
Thank you.
Thank you. The next question is from the line of Vivek Kumar from Best Pals Research and Advisory. Please go ahead.
Hi, Sharmaji. This question is regarding the demand for above 1 crore apartments, because we have large part of our pre-sales is from around 70% is from above 1 crore. How do you see that market shaping now that most of the launches are happening in the affordable part, and how do you see that outlook of demand for that part of the market?
See, we look at housing market like an automobile market or like a motorcycle market sort of a thing, where there are customers across all categories. So the luxury market per se has not shrunk. In India, if you look at from other parameters, it is becoming rich and rich are becoming more richer sort of a thing. And housing is one such thing where everyone has an aspiration to ensure that they get into better locations, they get into bigger homes. That era of having one address, one home, as our grandparents or probably parents used to have, is almost over. So per se, we are not worried about such demand contracting in any segment whatsoever. The issue was that the income growth, the inflation and the interest rates, it was hurting the segment where earlier everybody was addressing those customers. Now, among those customers, some of them have migrated to the affordable. Some of them continue to wait to get into the 3-bedroom, larger size products also. So, as such, we are not worried about this kind of a scenario developing. Rather, we welcome that more and more customers at a younger age, they have started coming and buying homes.
So you're confident of maintaining or increasing over the pre-sales that we have done this year, given the launches?
We told that yes, we have done the best ever performance as far as Bangalore market is concerned in the last financial year. And this year also we are confident that we should be doing better than that.
So can you throw more light on your business development plans apart from Bangalore? Since you were talking about Hyderabad, means are you going to launch this year, or are you seriously looking at it, or it's something that you will consider if something...
These are the things we do not as such discuss on a conference call, serious or not serious. If you are not serious, we will not be talking. Right. At the same time, what we are communicating is this, that we are very careful. We would like to protect our margins. We would like to identify right location, right pricing, and ensure that we work within the parameters what we have laid out for ourselves. And as such, not in a hurry, that we need to be there in a particular city next quarter itself.
Okay. So even the cash flow part, the 375 odd crores, we will be able to do much better this year, and able to maintain this.
Yes, if the performance improves, all these parameters definitely will improve.
Yeah. Thank you very much, sir. All the best.
Thank you. That was the last question in queue. I now hand the conference over to the management for their closing comments.
Okay, Shivash, you can close it. Yeah. So we would like to thank everybody who participated in this call. And mine and Bala's details are there on the investor presentation. So if there is any other specific questions that you need to be answered, you can reach out to us. Thank you.